You're listening to Real Talk Texas with local expert Steve Hakes. Now, here's Steve.
Well, welcome back. If you're just joining us, you're listening to Real Talk Texas. I'm Steve Hakes. I'm your host here on KLIF AM 570. Every Sunday at noon, you'll hear us talk to real experts in the market. Real Talk Texas is a forum for our listeners to listen to advice from real experts in the marketplace. And today, we've got Garry Graham of Affiliated Bank. He's our banking expert. And we've got Geni Manning of the Geni Manning Team of Keller Williams. And she's our real estate expert that we're talking with today about the real estate market. And one of the things we were talking about during break is, you hear the national news and what's happening. And, I think there's a lot of people still on the sidelines wondering if, because of national news, that we're still in a housing recession and all those things. And I think that what Geni's pointed out today is that this is a seller's market. So if you're a buyer and you're sitting on the sideline, I'm telling you, there's never been a better time. Now listen, there's never been a better time to buy a house or investment property than today. And why do I say that? One, I've got a real estate expert sitting in our studio today telling us that it's a seller's market. They're getting offers above the listing price today in the Metroplex. That's huge. That's huge news for us today. The other thing I'll tell you as a mortgage professional is that I've never seen rates as low as they are right now. And one of the things I'll challenge you with, and what I'll tell people is when you're out looking for a home, and I know that some of you listeners are sitting there thinking about buying a house at this time, is what I do with first-time buyers, or my son is 27 years old, Scott, and Scott is thinking about buying his first home. Now, Scott's, been out to college a few years. He doesn't have 20% to put down on a $200,000 house yet, but he has enough to get an FHA loan of 3.5% down or a 5% down on a Fannie Mae type of loan. And what I will tell you that I tell Scott today, I have a way with our customers when I send out a quote, I don't just send out a fee sheet. I send out a graphical conversation with the customer. They click on a link and they can see comparison of different things that I want to talk about their financial future. And there's even a little video of me talking to them, which that way they can hear me explain what they're looking at. And it's a great tool that we use here at Affiliated Bank. And one of the things that I show Scott is I go back in a snapshot of time. I will go back to 2 years ago at interest rates, and I'll compare that home that he's thinking about buying, that price. I'll take that 30-year mortgage rate 2 years ago compared to rates today on a 15-year note, and you'd be amazed. The monthly principal and interest payment, that part of the payment is almost identical to a 30-year note versus a 15-year note. Now, why would you, in your right mind, not take an equity builder 15-year loan? And I can show you after 5 years, and in this graphical thing, it'll show you how much your net worth has gone up. And when we talk about mortgages, we're talking about somebody's financial future. We really are. And a lot of mortgage people out there, the real professionals, the real experts out there will agree with me. The ones that just want to turn and burn a loan, they'll just quote you a rate and a fee and just push you out the door. But I don't think that's in the best interest of our listeners. I don't think it's the best interest of my clients. So I spend the time to counsel and coach. And, I've always coached people, and that's what I do. So, and when it comes to their mortgage, I really get into, what is that? And when I showed that to my son on a week ago Sunday, when he was getting ready, I said, now look at this in 5 years. You're making the same payment you would have 2 years ago. Yeah, I know rates are lower today. But let's just say if you would have bought a house 2 years ago, why not take the advantage of today's market? Don't really think about the 30-year loan. Go to a 15-year equity builder, and in 5 years, you're ready to move on. And one of the things I point out to, especially first-time FHA home buyers, VA people that are not putting money down, or a USDA loan, which is a zero-down loan in a rural market, those people, when they go to sell their home, they're going to pay about 6% to 7% to sell their house. Okay, so if in 5 years my family's grown, I'm ready to move on to my next house, I need to have equity for my next down payment. And if I have to pay to sell my house 6 to 7%, and I don't have that equity in there, I may end up paying to get out of my house. And that's something that a lot of first-time buyers don't really think about. And so that's one of the things that I do when I talk to my customers is, let's just think about the future a little bit, and that's a great thing to do, especially in today's market. I mean, I'm really great to hear that that the market's bounced back, and it is a seller's market today. Gary, one of the things I want to talk to you about is I know Affiliated Bank is really entrenched into community as a community bank. And, your efforts to help rebuild the housing market here in the Metroplex. One of the things that drew me to Affiliated Bank was when Garry and I talked about his Make Sense mortgage that Garry came up with and introduced, really pushed this year. And tell me a little bit about why you came up with a Make Sense mortgage. What is that, and how does that compare to agency loans?
Well, Steve, I'm going to digress just a minute to your comment about the interest rates, because I think that you've nailed it in the fact, and I think Geni's nailed it too. 80% of the mortgage volume that we see going through our mortgage business right now is buyers, and it's probably 80+%. So there's a lot of active buyers out there buying, and they're taking advantage of the rates. And I think a 15-year mortgage, I refinanced my house last year. Same thing. You've got the same payment or lower payment on a house that you had before, but now you get the equity build much faster in it. But we got into the Make Sense mortgage business because what we saw out there were the people that were in between. We call them tweeners most of the time. They don't quite qualify for some of the stringent secondary market standards. That is all tightened up out there with the financial problems and everything else at the big institutions. And if you've had an employment change, it can be small things such as an employment change, being self-employed. If you've had a family event, a divorce, a medical issue, there are all sorts of things that come in there that can affect your credit or really affect how you qualify under some of the stringent mortgage standards that are out there. Well, we decided we needed to get a product to meet that need in the marketplace for people that couldn't quite meet those stringent secondary market standards, but really deserve a mortgage and want a mortgage. And we think that's a huge space for us to fill in the marketplace. And part of the reason we got into the mortgage business to begin with, yes, we like the traffic we see on the secondary market side, but this is a chance for us to reach into the community and build our bank so it's a win-win deal and also provide mortgages out there to folks. And I think they'll find the rates competitive.
Yeah, and obviously as the national sales director for Affiliated Bank, I'm very in tune to the Make Sense mortgage. And if you want more information, you're listening out there and you want to hear or you want to talk to me about your situation, call me at 214-643-6021. Or go to realtalktexas.com. Just send me a quick note. And if you're having some difficulty out there and you think it makes sense for you to have a mortgage, then I've been doing this 14 years, and I can take a look at it, and I can tell you whether or not it makes sense for us as well. So one of the things I wanted to tell a story about, give an example of when this comes into play. And I'll give you an example. One of the things we had Stacy Langenbaum of Detente Mediation on a couple weeks ago, and she was talking about people that are going through a divorce, and a lot of times I help counsel her customers or her clients about, how your divorce settlement is going to affect you on a financial basis or on your mortgage basis. And one of the things that people don't realize is that when you go through a divorce and the judge hits the gavel and says, okay, she gets the house or he gets the house and you're no longer involved in that house. Well, nobody calls the bank or this mortgage company and says, hey, we want the spouse off of the loan. And when that doesn't happen, or when they don't reach out to a mortgage professional like myself and get that settled at that time, things can happen. So to give you an example, I had a nurse come in, and she was from the Philippines. She was married, and she got divorced about 6 years ago. And in her divorce, the judge said he gets the house. She went back to the Philippines for a couple of years and finished her education, visited family, came back to the United States. She has great credit. Her scores were close to 800. She had 20% to put down. She had money after closing, and she wanted to buy a house. Everything on paper looked great to me. As a lending person, I looked at it, looks great. Well, one of the things we do as a mortgage professional is we run what we call automated underwriting. And what that does is it takes it from our computer system, it sends it off to Fannie Mae's computer system, and it says, hey, will you buy this loan, or will you insure this loan for us? And it came back ineligible. And I couldn't figure out why. So I dug deeper, and then really low in her trade lines, her ex-husband didn't pay the mortgage, and it didn't go to foreclosure. What happened was it was paid for less than what the agreed upon value was. It was a deed in lieu of foreclosure, and it kicked it outside the box. Now, that was a make sense mortgage. So I went to our committee at Affiliated Bank and said, look, this person's really qualifies. It makes sense for us to do that mortgage. And Gary, I'm glad to say we got that home sold for the realtor. The customer's in the house. She was so excited. She was in tears because she had been turned down at other places as well. Mm-hmm. And it made sense to me, and it made sense to Affiliated Bank, and we hold that note right now. One of the things I wanted to ask you is we've got her in the Make Sense Mortgage. It's an ARM product, so she's good for 5 years, and then it adjusts after that. It's kind of a place where I would say we park the loan there while we get things cured, and then we can sell it to the agency. How does that process work once she gets things fixed?
Well, and that's really true. As a bank, we have to do things on an adjustable rate basis because of the nature of our business and the way we fund the institution through deposits, et cetera. So we have to do that. But, we like the avenue because you close the loan on our Make Sense Mortgage, and once you cure your issues, if you have issues, then we take it into the secondary market. We can modify the loan, take it into the secondary market. And if for some reason the standards in the secondary market change on what's acceptable, then you might have to refinance. But generally, we're going to try to do the low-cost option because it's low cost for both of us, the consumer and us, if we can just modify it and sell it into the secondary market, and we get them the great rate at that point.
So basically, at the end of once, for example, this person was 6 years, it needed to be 7 years from that event to be eligible for Fannie Mae. All I have to do at that point in a year is call them back up, tell them talk to them about different options as far as fixed rate products or that they may want to lock into. And then all we do is send out an appraiser, get an updated appraisal. We get the title company to refresh the title for us, make sure there's no additional liens on the property. And they don't even go to the title company. She just signs a modification that says, I'm now going to a fixed rate. And it's very transparent for them that all they do is sign a piece of paper. Now they're locked in. There's no closing costs. There's no new title fee because we own the loan already. So, it's a great modification and very easy to do. After the break, we're going to talk with real estate expert Geni Manning, and we'll also talk with Garry a little bit more about how these Make Sense mortgages can really help the real estate market and help Geni sell more homes. So stay tuned.